Hello everyone, welcome to Vysh IAS. I hope you're all doing well. Okay, so India's Forex Reserve soared to $600 billion. Okay, so the question is how can we join the $1 trillion club soon? So by July 14th, India's Forex Reserves stood at whopping 609.2 billion dollars as of July 14, 2023. Okay, making it the fifth largest Forex Reserves holder. So in this context, we are going to learn some of the things like balance of payments, forex reserves, and also we are going to look at the foreign trade policy that is announced in 2023. Okay, and before we get started, a small announcement for you. These topics are already covered in daily editorial videos, so it is recommended for you to watch both the daily editorials and these videos also. Okay, because the topics that require much analysis, they are done like this in separate videos, so do watch both editorial videos and these videos also. Okay, so let's begin now. So the context is like India's forex reserves as of July 14th has reached 609, okay, to be very accurate, 609.02 billion dollars. Okay, so making it the fifth largest forex reserves holder. Okay, like the first one is China, and then Japan, Switzerland, and Russia. So after Russia, India has taken the position now, making it the fifth largest forex reserves holder. So this is the highest level in the last 15 months. And also forex reserves, they definitely indicate the country's resilience and also economic strength. And before we get into the details, let's first understand what a balance of payment is. Okay, so balance of payment, it is like a systematic record of all economic transactions, okay, made between the residents and non-residents of a country for a specific time period. Okay, it is like a record of transactions between the residents and non-residents. So they are classified into two. Okay, one is current account and then the another one is capital account or financial account. So every country, okay, every central bank of every country, they have to prepare the balance of payment records every year, okay, according to the format that is given by IMF's BPM 6 manual. So this is the manual that every central bank follows for making the balance of payment okay record, and they have to publish that record in figures like only dollars. Okay, and so since every country, so if you talk about the world's net balance of payment, it is zero. Okay, because one country's debit becomes the another country's credit, so in total the net world balance of payment would definitely be zero. And if we talk more about RBI's actual method of classifying balance of payment, so it is usually classified into two. One, the first one is current account, and on the other side we have this capital or financial account. And on the current account, we have again, so what makes up the current account? Goods and services. Okay, goods and services that are traded, primary income, wages of the employees that are settled, okay, overseas, and dividend on shares, and interest on loans given. And then secondary income means remittances, okay, from overseas, gifts or donations. So all these things come under the current account. And now if we talk about the capital account, the first one is foreign direct investment, okay, and then foreign portfolio investment, loans or external commercial borrowings. Okay, loans are also nothing but external commercial borrowings. External commercial borrowing is nothing but non-sovereign external debt. If we talk about sovereign external debt, that is government's debt, external debt. And non-residents investments in banks, okay, insurance, pension schemes. And apart from that, the last one, RBI's foreign exchange reserve. So all these come under the capital or a financial account. And if we talk specifically about the current account, so like I told, current account also includes goods and services traded across the countries and exports. So these are the like the top exports. Okay, goods, okay, top goods that are exported from the country: petroleum products, gems and jewelry, organic and inorganic chemicals, drugs and pharmaceuticals, according to the latest economic survey 2022 to 2023. And if we talk about the export services, telecommunications, computer and information services, transport, travel services, and financial services. And then top agricultural exports that are okay, that are exported from India: marine products, non-basmati rice, okay, spices, sugar, and buffalo meat. So these are like the five, okay, top five agricultural exports from India. And if we talk about imports, so these are the imports, okay, goods that are imported. So these are the top, okay, six goods. So crude oil, electronic goods, coal, okay, coal machinery, okay, gold, and then chemicals. And the top services that are imported are business services, transport, travel, okay, fees paid for using intellectual property and all. And then coming to the India's trade partners in terms of export and import, top destination of India's exports. The first one occupied by USA. The second one is UAE, and then Netherlands. So these are the top destination for India's exports. Apart from these things, we have other notable partners also, like Bangladesh, Hong Kong, Singapore, Netherlands, Britain, okay, Belgium, and Germany. And then on the other hand, we have top sources of Indian imports. So the first one is occupied by China. Okay, we get most of the imports from China. And then the second position, okay, it is held by UAE and then USA. And then we have other notable partners also, like Saudi, Iraq, Switzerland. And we import mostly diamonds from Hong Kong, and of course palm oil from Indonesia, Singapore, and South Korea. So these are like the top sources of Indian imports. And now let's talk about the foreign trade policy 2023. So this is recently announced in 2023. So this replaces the foreign trade policy 2025. Okay, this is managed by Ministry of Commerce. And the target of this foreign trade policy is to increase India's exports from the present 750 to 760 billion dollars to $2 trillion by 2030. Okay, so we can study the foreign trade policy under four main points actually. So the first one, incentives to remission. So there are different schemes that provide some incentives, okay, that provide from like incentives in the form of tax refunds and all, okay, export promotion, capital goods scheme, okay, remission on duties and taxes, okay, and then advance authorization scheme, all these things. We'll see each of that in detail. And then government is also focusing on ease of doing business initiatives, okay, and also reduction in transaction cost and initiatives. And then it is also focusing on emerging areas like e-commerce, developing districts as export hubs, and also streamlining SCOMET policy. And apart from that, fourth point, export promotion is also being done through collaborations, okay, collaborations between exporters, states, districts, and also Indian embassies who are working abroad. Okay, if we talk specifically about incentives to remission, the first one is RODTP, so which means that remission of duties and taxes on exported products. Okay, so exporters who pay taxes on inputs, they will be provided some refunds under this scheme. And export promotion capital goods scheme, so EPCG. So here what happens is, for example, some exporter is actually importing some machinery for creation of goods. So on that capital machinery, goods machinery, it will be getting tax refunds. Okay, so 0% customs duty would be imposed. And specifically, these are the areas that are going to be benefited according to the foreign trade policy 2023: textile parks in PM Mitra, okay, dairy, green hydrogen, battery, electric vehicles, vertical farming, equipment, wastewater treatment, rainwater harvesting system. So if you face any mains question on any of these things, so you can see that these sectors are actually, they will be getting benefited under this scheme, export promotion capital goods scheme, because 0% customs duty would be imposed on the machinery that will be imported for export promotion. And then advance authorization scheme, 0% customs on import of raw material. So if you are importing any raw material for the production of export items, then 0% customs duty would be imposed according to this advance authorization scheme. And then there are a few initiatives like one-time amnesty scheme on default on export obligations. So according to this, so every exporter who are actually getting benefited from all the schemes that we have discussed above, like export promotion of capital goods and all, they have to fulfill some export quota. Okay, if they have to get benefit, then they have to fulfill some export quota. If they do not fulfill that, then they would be they will have to pay some fine or penalty. So, but according to this recent foreign trade policy 2023, they would be given waiver. Okay, they would be waived off one time amnesty scheme on default on export obligations. And then there are some emerging, okay, there is some focus on emerging areas like SCOMET, okay, dual use goods, e-commerce and mercantile trade. SCOMET is it's nothing but special chemicals, organisms, materials, equipment and technologies. Okay, dual use goods are nothing but the goods that are used for both civil purposes and military purposes. For example, night vision, okay, night vision scanners, drones and all. So under this foreign trade policy 2023, they will be so the government will promote their exports. Okay, collaboration of stakeholders. So under this, the government is actually trying to develop districts as export hubs. Okay, districts as export hubs, and with the help of one district one product scheme, it is actually trying to develop districts as export hubs. And also the exporters will be given star rating or status based on their export performance, so as to induce some competition between the exporters. And then according to this, again, foreign trade policy, a few towns like 30, apart from existing 39 towns, these 4 towns will also get the status of towns of export excellence. Okay, so as to develop export infrastructure, okay, and also to provide funding to develop this infrastructure and all, like warehouse, ports and all. And apart from this, market access initiative, so this, under this initiative, the government is to give some funds, okay, to do some research, okay, across different countries, so as to know the different countries preferences, likes or dislikes, so that it will definitely get the exporters in India, so that they will get to know what the other countries customers preferences are. Okay, so now let's understand what capital account is. We have classified this capital account into FDI and FPI. Okay, FDI is nothing but it is a foreign entity, okay, that is registered under SEBI, and it has to have at least 10%, okay, up to 10%, not at least 10%, sorry, only below 10%. It needs to hold 10% in equity or shares of any Indian company. Okay, and FDI means if that entity holds more than 10%, then it would become FDI. If it holds less than 10%, then it is FPI, that is foreign portfolio investor. Okay, FDI is foreign direct investment. So if it holds more than 10% equity, then that would be FDI, and it also needs to have some in it needs to be involved in the management or production of the company. And now if we talk about the sector wise, okay, figures, so here computer software and hardware is the industry that receives the most FDI out of all. And then in the second position, services sector, and then trading. And now coming to the country wise, we India gets FDI the most from Singapore, and then Mauritius, UAE and USA. So these data is as per the economic survey 2022 to 2023. And external debt repayment denominated in, so most of the external debt, okay, that has to be repaid, it is denominated in US dollars. It makes up to 55%, whereas the Indian rupee, it makes up to 30%, okay, and the other currencies are 14% only. Okay, external debt composition. So basically, external debt can be classified into two: sovereign external debt and non-sovereign external debt. Sovereign external debt is of the government's debt, okay, that is taken from abroad, like IMF or anything. And non-sovereign external debt is nothing but external commercial borrowing. When private or commercial entities, if they take loans from abroad, then that is external commercial borrowing. And out of the total debt composition, external commercial borrowing makes up to 79.6%, and sovereign external debt makes up to 20.4%. Okay, now let's talk about RBI's Forex Reserve composition. So basically, RBI's Forex Reserves, they are composed of foreign currency assets. So they might include foreign currencies, different foreign currencies of different countries, and they might also include the government securities of foreign governments and also gold. And apart from that, reserve tranche position in the IMF. So what do you mean by reserve tranche position? We'll see that in a while. And special drawing right, so this is like an accounting mechanism of International Monetary Fund. So all these things would make up the forex reserves. Okay. And so IMF's special drawing rights. So special drawing rights is like the accounting mechanism of the IMF. Okay. So every member of IMF would have to deposit currencies in the proportion of quotas allotted to them, and that will be depending on the size of their economy, like the GDP, okay, and then the openness of the economy, and etc. So every country would be allotted some quota, and according to that quota they have to make some deposits with the IMF, and IMF will in turn pay them a small interest rate, okay, for their deposits. So IMF uses all this money for lending to any member who is facing any balance of payment crisis. Okay. So India faced balance of payment crisis situation in 1980s. So that is when India took loan from IMF. So this is what the mechanism is. So IMF would lend this money that is collected in the form of deposits to any member who are facing balance of payment crisis. Okay. And so initially the price of SDR, okay, the price of SDR, it used to be fixed against the amount of gold. However, the present mechanism is something different. They apply some formula, and then the IMF will obtain the value of one SDR. Okay, so currently one SDR is equal to $1.4. Okay, $1.4, and this SDR is like a paper gold. It is usually called as a paper gold because it's merely an accounting entry or accounting mechanism or artificial currency, okay, without any gold involved. And this can be SDR can be traded among members, and it can be even converted to countries countries currencies, okay, so that they can settle their balance of payment transactions, okay, with other nations. So individual nations, central banks, they can keep some of this SDR as a reserve tranche position. So this is what reserve tranche position is. So reserve tranche position and SDR, they can be used interchangeably, because reserve tranche position is nothing but some, okay, it's like a proportion of the SDR. Okay, significance of forex reserves. So according to the economy, according to the latest data from the RBI, as of July 14th, India's forex reserve stood at whopping 609, okay, to be very accurate, $609 billion, and making it the fifth largest forex reserves holder, okay, after China, Japan, Switzerland, and Russia. And of course, there is some significance for the forex reserves. These forex reserves can be in the form of, like we told, okay, it can be in the form of foreign currency assets or gold or SDR, okay, or even reserve tranche position. So this forex reserves, they serve many purposes, okay, like they keep the current country's currency and exchange rate stable, okay, and then it shields economies from external shocks and crisis. It also helps countries bounce back from a crisis or boost its growth, and it also provides liquidity during crisis. And also, if we have highest amount of forex reserves, it will also lure foreign investment, and it also increases investors confidence. So that is how we can improve FDIs and FPIs. And if we have highest forex reserves, it will also make international trade easier, okay, by ensuring a country can pay for imports or convert its currency to other currencies for export. So that is how it can make international trade easier. Okay. Factors behind the increase, of course, due to rise in foreign direct investment, steady increase in exports, strong inflow of remittances, and foreign portfolio investments. So benefits of high forex reserves, we have seen this already. So there are a lot of benefits. Uh, it can definitely provide a buffer of like 18 months of import cover, okay, which means that even if all the foreign inflows stop, India can still pay for its imports for more than a year and a half. Okay, so this automatically reduces the risk of the economy being affected by sudden changes in global market conditions, right? For example, the geopolitical tensions like Russia Ukraine war. So the Indian economy can definitely get resilient from such geopolitical tensions if we have the highest forex reserves. And also, other benefit that we can talk about is it improves the credit worthiness of the country, right? So that is how it can enable India to borrow at lower interest rates from international markets. So and then it also thereby it reduces the cost of servicing external debt. Okay, and it also frees up resources for domestic development. And so these are the different benefits of having high forex reserves, and it will definitely have an impact on Indian economy, like it increased borrowing capacity at lower interest rates. Okay, and then a positive impact on rupee value, lower dependency on foreign borrowings, and it will strengthen economic position on the global stage. And if we compare this with different countries, India's forex reserves are among the highest in the world, because India is currently positioned at the 5th place. Okay, uh, after China, Japan, Switzerland, and Russia. And China has like the largest forex reserves, and also forex reserves of emerging economies are also improving. And if we talk about the future outlook, we can see the rise in exports and remittances. Okay, so that is how we can even achieve the target that is set by the foreign trade policy 2023, that is we can achieve the $2 trillion trade by 2030. Okay, and then we can even see the steady inflows of foreign investments, and we can see the forex reserves are expected to continue growing. Okay, so that we can achieve $1 trillion also. And government measures to attract investment. So these are the things that we can look out for the future. And in conclusion, so India's forex reserves, it gives the RBI, okay, more flexibility and firepower to intervene in the foreign exchange market and maintain exchange rate stability. So this definitely helps in avoiding excessive volatility, okay, or depreciation of the rupee, which can have negative effects on inflation and all. So and also furthermore, India's forex reserves, it definitely boosts the confidence of domestic and foreign investors in the strength and resilience of the Indian economy. So this definitely attracts capital inflows, and of course, in turn, it stimulates the economic activity. And having great highest amounts of forex reserves, they reflect the strength, stability, and resilience of the Indian economy. Okay, so it also provides a strong foundation for future growth and development. So that is the end of this video. So we have seen like a lot of things. We have discussed what a balance of payment is. We have seen like the current account, capital account. Okay, and then India's current position in the forex reserve. So what are the benefits and what are the significance of having highest amount of forex reserves and all. So this is going to be your practice mains question. So discuss the factors contributing to the rise in forex reserves and how this development can influence India's economic stability and policy choices. So this is going to be your practice mains question. Okay, so I hope you gain some valuable insights, okay, into what is happening currently. So I'll see you in the next video. Thank you for watching.